The videos is going to be based on the formula of aggregate demand. So within each of the videos, we're going to be looking at consumption, we're going to be looking at government expenditure, we're going to be looking at net exports, and in this particular video, investment. And we're just going to look at, well, how do they actually influence aggregate demand? And also, what can actually impact these components, causing these to increase or decrease, and therefore obviously having an impact on whether aggregate demand increases or not. We're going to look at it from a point of view of the UK, so we're going to look at how it contributes towards the UK's GDP. But to begin with regards to investment, it's through the purchase of capital stock. So what I mean by capital stock is it could be equipment and software. It could be the inventories of maybe machinery. It could be non-residential structures. So for example, if a firm buys a new factory site. When we're talking about machinery, equipment, software, it could be to do with the research and development into improving this software or this machinery. It could be just purchasing new machinery. But with every aspect, the whole idea of it is that we're buying a man-made factory of production to try and boost the ability to produce more capital goods or consumer goods in the future. So when we're looking at it in terms of aggregate demand, obviously aggregate demand relates to the total demand within the economy, and when we're looking at investment, we're pretty much looking at the total investment within the economy, or the average investment as to what we can calculate. So when we're looking at it in terms of its contribution towards the UK GDP, if we look at it from 1970 to 2019, roughly it's been around 20%. In 2019, the last recorded percentage was 17.39%, and you can imagine in 2020 it's probably dipped because of the pandemic. Now, why is this figure important? Well, what we need to do is we need to think about all the other components of the aggregate demand formula and how much they account for in terms of its percentage of GDP. Now, consumption is significantly higher. Government expenditure, especially at this time, will be higher. Investment will be higher than net exports, because net exports actually is a small percentage of UK GDP. But when we're looking at that figure of, let's say, 20%, it's also really important not just to look at the short run factors, but also the long run. Because the whole idea of investment is we're trying to boost the productive potential of the economy. So when we're looking at it from a PPF point of view, imagine that the economy that we're in is operating at PPF 1, but suddenly we start to invest more in capital goods and capital stock. And because of that purchase of capital stock, or that development of capital stock, we can now produce more capital, but also more consumer goods. So we're shifting from PPF 1 to PPF 2. And that's boosting the amounts that the UK, for example, if it was the UK we're looking at, could produce that it could before the investment was carried out. And that's why it's absolutely crucial, because we're not looking at just an injection, but we're also looking at how it can improve the capacity of what is being produced within a country. Now, in terms of the short run, we can definitely look at it from circular flow of income in terms of an injection into national income. And what firms will do is, if they're generating high levels of profit, they've obviously got a couple of options. It can be given as dividends to shareholders, it could be just stored, or it could be reinvested back into the company. And when you're reinvesting back into the company, obviously they're looking to expand, they're looking to grow, and they're looking to produce more goods. And that would be that injection. If a firm might need a little bit of support in terms of investing, then they might turn to a bank. And when they go into a bank, obviously they're getting that loan and they'll be increasing their gearing. And all I mean by gearing is that I suppose debt to equity ratio in terms of their expanding via debt. And the reason why they're willing to do that is because they know about the returns of that investment and what it will mean for the company in the future. And obviously we're not just talking about one company, we're talking about investment of the whole economy. So when we're looking at the aggregate demand and aggregate supply diagram, I've just done a Keynesian viewpoint here, but clearly I've just said it's an injection into national income. And that injection into national income straight away causes aggregate demand 1 to shift to aggregate demand 2. And the reason for that is because if there's a high level of investment and suddenly, let's say the average percentage of investment is rising, that means more companies are purchasing more capital stock, and that purchasing of capital stock will obviously lead to that aggregate demand shifting from AD1 to AD2. But that's just in the short run. What we also need to think about is, if this investment is successful, then actually, as I said before, by that shift of the PPF, we should be able to increase the long-run aggregate supply as well, because we're able to produce more in the future. And therefore we'll get not only an AD shift from AD1 to AD2, but if successful, it'll be also long-run aggregate supply shift to long-run aggregate supply 2 as well. And that's absolutely crucial to consider. But again, it obviously depends on how successful this investment is. Now, what can impact investment and what can influence the levels of investment? Well, first of all, the interest rate can. And as you can see in the background, the interest rates in the UK, they've been low for some time. So when we think about it from 2008 and the Great Recession, interest rates dropped pretty dramatically and they've remained low for quite a long time. One of the reasons is because the government were carrying out an act of austerity, and therefore they believed that expansion in monetary policy and making sure that the interest rate was low would help the recovery whilst they were, for example, cutting expenditure. Now, keeping interest rates low, why it matters is because we can see that the rate of interest it measures the opportunity cost of purchasing business capital. Because if the interest rate rises and it increases, then obviously the cost of borrowing for that investment is going to go up as well, and it might not be worth it. So the whole idea of if the interest rate is low, then the cost of borrowing is going to be low, and therefore it incentivizes and encourages firms to carry out the investment now, because obviously the payback will not be as expensive. Now, and another factor we could consider is in terms of future expectations in the economic cycle. If the economy is not doing well, then you can imagine that firms have got a lack of confidence with how the economy is operating and what that might mean for the future. If we're in a recession, like we are at the moment, then probably firms they're going to put investment on hold, because they're going to wait for greater stability and they're going to wait for that recovery to kick in. If economic growth or GDP is falling, or consumption is dropping, then firms might think, well, what's the point of investing? What's the point of boosting our productive potential if at the moment we're not even reaching our current capacity because there's a lack of consumption? So they're not going to want to produce even more output at this point in time, so they might put it on hold. But if they've got positive expectations for the future, then they might start to think, okay, well, let's plan for the future and let's start to invest. So if the economy is growing and it's recovering at a fast rate, then you're going to see a greater chance of investment. So as I've said here, if we consider the US in the 1990s, investment levels surged from 18% in 1994 to 21% in the year 2000. However, when the recession started in 2001, suddenly investment levels quickly sank back to 18% of GDP. So we can see that as soon as the recession hit, firms just put their investment on hold, or there was that dip from what it was before. And that's just about negative confidence, negative expectations, and not really getting a return for that investment. Now, another factor could be government policy, and government policy could be in terms of corporation tax. Now, corporation tax is a tax on profits, and therefore, when we think about countries such as Ireland, they've got very, very low corporation tax rates of 12.5%. It's some of the lowest in the world. And that has allowed, or it's enabled firms to reinvest because they've got higher profit levels, because they're not getting taxed as much. It has also encouraged foreign direct investment, but I am just looking at it from the point of view of domestic investment, so I'm not going to delve into that too much. But if you know that the corporation tax rate is going to be reduced, or it has just been reduced, then you're going to be more positive about what you could do with your profits, because you've got more profits to use. And again, as long as they're not issuing them out as dividends, as long as they're not just storing it, but if they're reinvesting it, then there's greater chance of investment taking place.